you are just joining, you have joined the Corporate Taxation Primer tax section of the Florida Bar. Attorneys of Comiter and Singer are joining us here today to provide a summary of the U.S. federal income taxation of Subchapter C corporations. And so if that's where you intend to be, you are in the right place. Just another couple of seconds. We have lots of participants on the line. I am going to give the code here at the beginning of the session and then again at the session. So the code for today's CLE is 8207, 8207. My name is Jennifer Migliori. I'm the Assistant Director of the Education Committee of the Tax Section of the Florida Bar. If you happen to have a great idea for a tax section CLE topic, please reach out to me. It's at jmigliori@duanemorris.com. We'll go ahead and drop that email address in the chat. If you can, we're always open to some great ideas for CLE presentations and wonderful presenters. We're very grateful for that. So looks like our numbers are pretty good. We can go ahead and get started. The CLE code is 8207 for those who missed it when I said it a moment ago. I'd like to take this opportunity to mention a few upcoming events presented by the tax section of the Florida Bar. The first is our monthly CLE. Our next one will be held April 17th. And Ann Haggerty of Snowden Lane will join us. And the topic will be the Secure Act, a retirement plan payout, IRA beneficiary designations, and proposed regulations. So she'll be covering the Secure Act, which is a great topic. And then also our annual meeting, the tax section annual meeting, will be held May 2nd through May 5th at Atlantis Paradise Island. And my understanding is that registration is now open for that. So please register and join us at the tax section annual meeting. All right, we have a good showing of participants. So it is my pleasure to introduce our sponsor for the day. Marshall is joining us from Jones Lowry. Hi, Marshall.
Hello, everybody. I'm Marshall Jones. I established Jones Lowry back in 1992, and Mac Lowry, my partner, and Adam Sensichu, my partner, the three of us are very pleased to continue to support the tax section. We have offices in Ponte Vedra, Fort Lauderdale, Miami, Palm Beach, and we travel wherever you want us to come by Zoom or in person. Our firm specializes in non-retail life insurance for ultra high net worth clients. We've been doing that for a number of years. This is our second decade now, 15 plus years, through M Financial, a firm that allows us to develop better priced products that we monitor for our clients' behalf through our reinsurance company. It's a pleasure to be with you. Look forward to hearing the presentation.
Marshall, thank you so much for your sponsorship of the tax section of the Florida Bar. We're excited to have you today. Thank you. So I will now introduce our speakers, Adam Smith, Owen Evans of Comiter, Singer. Adam joins us today from Comiter, Singer. He earned his bachelor's and master's degree in accounting from the University of Illinois and JD and LLM in taxation from the University of Florida. Adam's practice focuses on U.S. international taxation, federal income tax of business and entities, mergers and acquisitions, and tax controversy. Adam has experience in both tax law and public accounting. Adam had previous experience at the National Tax Department of a Big Four accounting firm where he specialized in international tax and transaction services. And his past experience also includes appointments at the University of Florida, where he was a director of student advising graduate tax program. And he's also practiced as an attorney for the IRS. Owen Evans is senior counsel with Comiter Singer. He obtained his bachelor's of arts in economics from Princeton University, graduated magna cum laude from the University of Georgia, and went on to earn his LLM from NYU. Clerked for the Honorable Arthur Nims, and it is he's a member of the Florida Bar since 2002. The focus of Owen's practice is federal taxation of partnerships, S corporations, limited liability companies, entity selection, and design of business structures. Thank you, Adam and Owen, for joining us today. I just want to say before we get started, if you have questions, please put your questions in the chat box. Adam and Owen, you can decide whether it makes sense at the point of your presentation to address them, or if you will address them at the end of your presentation. I am now passing the mic to both Adam and Owen. Thank you for joining us today.
Thanks, Jennifer, and another shout out to Marshall and Jones Lowry. We really appreciate. I'm also the director of sponsorship for the tax section, so I want to extend our appreciation for your continued support, Marshall, and your team over there. You're wonderful.
Thank you. Thank you.
So
Adam, you're welcome to join your. You're welcome to share your screen.
Yeah, and I'm about to do that. Let's see here. So we're gonna do the slides here. Okay. So you should see that, and then I'll put it in presentation mode. So you should be able to see the slides now. Is that right? Everybody good? Okay. Well, welcome everybody, and thanks for joining. If my head turns, it's because I have my slides on a separate screen over here. What we wanted to do, we did this last year for partnership taxes, provide sort of a very high level framework for you to understand how the taxation of subchapter C corporations works, some of the important considerations when you're advising clients. And so the goal really isn't to get into the nitty-gritty details here, but more to build a framework for you to issue spot and dive a little bit deeper, figure out the areas where you might need to dive a little bit deeper when you advise clients on entity classification, entity structure, and choice of entity. We're going to talk a little bit about capital structure and how that affects the analysis and some of the differences between the two. And then we'll get into the fundamentals of the key areas of corporate tax. So here we've put together a bit of a roadmap. We're going to take you through the life cycle of a corporation. So starting from choice of entity, capital structure formation, contributions, and then distributions, redemptions, and liquidations. All of those are distributions that occur from the corporation to the shareholders that have different types of consequences. And then we'll talk a little bit about taxable acquisitions and reorganizations. But I want you to understand that those components of subchapter C are an entirely separate course in an LLM program. So again, we're just going to hit the high level points here. At this point, I think what I'm going to do is I'm going to turn it over to Owen. Owen does a lot of choice of entity advising, and what we're going to do here is compare C corporations, S corporations, and partnerships. We won't get into sole proprietorships because they're just treated as a Schedule C. So I'll turn it over to Owen. Sorry.
So to start off with, C corporations don't come into play that often unless you have a publicly traded entity, or you have a situation like in a venture capital firm where you might want to use a C corporation as a blocker. But recently, and Adam can speak a lot more about this than I can. Recently, they've sort of come into their own, not only because of the Section 1202 treatment of corporate stock, but also because there was a significant reduction in the corporate tax rate down to 21%. So as of right now, the combination of the corporate tax rate and the tax rate that shareholders pay on dividends is very, very close to the tax rate that an individual would pay on a flow-through. So that combination combined with 1202 makes C corporations desirable in many cases at this point. One of the things that is true for C corporations, it's really as compared to S corporations, is that you can carve up the equity in a C corporation pretty much any way you want to, as opposed to just having a single class of stock, which is what goes on in the S corps. Adam, do you want to talk a little bit about 1202 now, or did you want to do that later?
Yeah, so I don't know how many of you were at the Florida Tax Institute. There was a whole presentation on section 1202. So 1202 is QSBS, stands for Qualified Small Business Stock. And what it does is for stock issued during a certain period of time, right now it's up to a 100% gain exclusion when a founder sells those shares. But in order to qualify, it has to be C corporation stock from the time of initial issuance. And there are some other requirements. But the point is that, if you're not a C corporation, then the shareholders aren't going to qualify for this gain exclusion. And the gain exclusion is the greater of 10 times your basis when you receive the stock, or $10 million. So, basically, if your basis is any more than $1 million at the time that you receive the stock, and there's some rules around how you calculate basis, but you could get a 10x gain exclusion, which is a huge benefit. And I've helped a lot of clients achieve that benefit. And it's probably one of the most lucrative provisions for tax planning right now for startup companies that aren't in certain prohibited areas. Unfortunately, lawyers, accountants, architects, and consultants don't qualify, nor do doctors. So they did a nice job of taking us out of the mix. But that's 1202 in a nutshell.
Okay, great. Thank you, Adam. So S corporations have got, in my opinion, they've got a couple of significant advantages over other types of entities. And they've got some serious drawbacks too. But the advantages that you get are, it's possible to limit self-employment tax if you have an S corp. It's a flow through, so you only get you only have one level of tax. And then there's this, and if you have someone that's a very high earner, if you limit their wage income, you can wind up reducing the self-employment tax that they have to pay with an S corporation. So there are a couple of things about S corporations that are not great. And the first one is that you can only have one class of stock with an S corporation. It doesn't mean you can't have voting, and it doesn't mean you can't have options. What they're saying is that if you are actually issued shares, or you are a shareholder, then the rights to receiving current and liquidating distributions have to be the same as a percentage basis for each of this, for everybody that has shares. There's only one class of stock. One of the other significant drawbacks is that unlike partnerships, there's no basis for the entity's debt and the shareholders. There's no outside basis for debt. And that can be very, very, very significant if you have debt finance deductions like depreciation. And for that reason, you should probably keep real estate out of S corporations. They do allow some basis for debt if it's a shareholder that's actually loaned the money to the S corporation and the debt's considered to be bona fide. Also, you should know that in the 11th Circuit, there is a case called Selfie versus Commissioner, and that's an older case, but basically it got into this discussion about, who was the bank really looking at for repayment? Was the bank really looking at the shareholder or the corporation? And it did allow some basis for that debt. The 11th Circuit is the only circuit in the country where I think that's permitted. And even here, if you wind up, you'll go to appeals if you try to use it. But it's good to know if you have a client that's made a bad mistake. So
I think, and I apologize for my son dropping in on us, but he's home with a fever.
That's good.
Yeah. So I mean, moral of the story is, look, C corporations are subject to double tax. S corp, that's tax at the entity level and then at the shareholder level. S corporations are flow through, but you're limited on your classes of stock. Partnerships we covered last year, but what they do is they provide you a lot more flexibility in how you do your allocations, and you do get basis for your share of the partnership's debt. And then LLCs, we'll talk a little bit about, forming corporations, but LLCs can be taxed as a disregarded entity or sole proprietorship. They can be taxed as C corporations, S corporations, or partnerships, and that's all based on the check the box election regime, which is in 301-7701-2 and 3.
Yep.
Yeah, so I'm gonna just try to speed through these because we got to keep going.
Yeah.
So the check the box rules, basically, if it's a corporation under state law, if you form an Inc., what we say in law, it's a corporation. If it's an LLC, you have to check the box. You file an 8832 to treat it as a corporation, or you could file a 2553 to make it an S corporation. Foreign entities is based on there's a list of per se corporations in the 7701-2 regs. If you don't fall within those, it's an eligible entity, and it looks to the legal liability of the owners. So that's pretty much your options. I think we'll move on now to capital structure. This is another really important consideration, and I'm gonna let Owen handle this one as well. But he and I were discussing this before, and I thought maybe this construct might be helpful as Owen talks through some of the issues here. But on one hand, so if you think of this as a spectrum, you're going to have on the far left of the spectrum pure debt. Just the debt holder is entitled to repayment of the principal plus interest. And on the other side of the spectrum, somebody who has pure equity, full upside potential. And then somewhere in between are these hybrid instruments, which is a mix of debt and equity. So, why don't you take us through sort of like the tax analysis and some of the financial considerations of debt versus equity?
Sure. So there's some tax advantages there. Let me go through sort of what I think are the major benefits to debt, right? The first one is that interest is deductible most of the time. There are limitations on that, but you can deduct the interest that you're paying. And of course, that's included in the income of the creditor, but it's good for the corporation. One other good thing about it is that if you pay the debt off early, the return of principal isn't taxable. So you can think about that as compared to equity, right? Where the only way you get your basis back is you either have to sell your equity, or it has to be redeemed or liquidated. You could basically have to wait until you exit to get your basis back, but you can get it out early with debt. And then one other big key, which is not necessarily a tax item, is the fact that debt has priority over equity on liquidation. And so those are fairly important things. You want to move on to let's go to slide 11.
Okay.
So these are some of the main features of equity when you look at it. In addition to this, voting rights, dividends if they're declared. They get the net assets on liquidation, so presumably they'll get whatever's left over, and sometimes that can be more significant than what debt holders get paid. There's also, so the upside is very significant, and then also what's not on here, but what Adam talked about earlier was 1202 tax treatment on equity if it's common stock. Okay, so there's one way to think about it. Yeah, that's a great slide. Just leave it right there on 13. One way to think about it is that debt is limited. Most of the time, the return that you get on debt is limited, and the return on equity just depends upon how good the company does. And so that's that. Then, in terms of like how do you tell the difference between debt or equity, and for tax purposes, why don't we go ahead and go to slide 15, which talks about the mixing factors. I'm not going to talk about all of these. Basically, it's a facts and circumstances test that they have. There are a couple that I think I'd like to draw your attention, and starting with number 4 on this list, which is the right to enforce payment. And that is one of the things that's sort of like a core to the idea of debt is that there is an obligation to repay the principal and to pay interest that's not contingent on the success of the business or the earnings of the business. And that's a very core.
I'm going to go back to this slide because I think this is what this slide illustrates. It is if what you see here is if the corporation is actually losing income, it is a net loss. The debt holders still get paid. They get paid their interest and principal, or at least there's a binding obligation for the corporation to pay the debt. And then as you move along this line where the corporation's net income increases at a certain point, the corporation only has enough income to pay off all of its liabilities, and then the equity holders then turn to the place of profiting from the growth of the business. So true equity versus true debt, you're participating in that upside potential, and that's really what a lot of these factors are getting at. Is it goes to debtor creditor law, it goes to thing capitalization, some of these other issues. But if you put all of these 13 factors together, it's really summed up in that chart.
Yeah, and also one thing to keep in mind is that if you are dealing with related party debt, the courts are going to look at that a lot more closely than they would if it was third party debt. Right. So, and the thin or adequate capitalization, if it's a related party debt, is very important to keep in mind, and especially if it's proportionate, like if all of the equity holders own the same type of debt in the same proportion, it's likely to be recharacterized as equity if you do that.
Yep.
So, so that's basically 8 and 9, and the others are other factors. Obviously, if they're applicable, they'll go into play.
Right.
But so you want to move on to formation, Adam? You want to talk about that?
Okay. So we put some extra slides in here. This just shows you a comparison, assuming like $200 of income, $100 repaid to the shareholders, debt versus equity, and the tax advantage of debt versus equity. And of course, that's subject to things like a 163J limitation and several other points. So we'll let you go through that on your own time. But in the interest of time, we're going to move on now to formation. So we've advised our client, we've considered all what type of entity we're going to use. We've decided we're going to use a corporation. We've decided we're going to use equity to capitalize the corporation. Now we're getting into, okay, well, we're going to form this corporation and we're going to contribute something to the corporation as new shareholders in exchange for the equity of the corporation. And how does that work? So Section 351, just to take everybody back to their basic tax class, remember that every sale or exchange of property, any dealing in property under 6183 and 1001C results in gain recognition, gain realization, and gain recognition, unless there's an exception in the code that prevents the gain recognition from occurring. And 351 is the subchapter C provision. There's also, and I love doing this because it helps people sort of remember the non-recognition provisions with business entity taxation. 351. 361 is the reorganization rule where the shareholders don't pay tax. We'll talk about that a little bit later. In partnership tax, it's 721. You'll notice there's a 1 at the end of each of these. And in property exchanges, 1031, like-kind exchanges. So the principle behind this is really that there's no change in the underlying investment. It's just the way that you hold that investment. You're putting it into a corporate solution as opposed to holding it directly. And with each of these, there are benefits and detriments to each. So with a corporation, there are 3 elements to get non-recognition. One is you have to have a transfer of property to the corporation. A transfer of services is not eligible for non-recognition. In other words, the transferor of services or provider of services to a corporation in exchange for stock recognizes income. We can talk about Section 83 on another day, which relates to receipt of property for services, but there are ways to minimize the consequence of that. We'll leave that for another day. That's 1, transfer of property to a corporation. 2, solely in exchange for stock. And we'll talk a little bit about what happens when you get something other than stock of the corporation back. And then 3 is this control requirement. And I want to note that I have it here as a practice tip. We're talking about choice of entity. Partnerships do not have this control requirement in 721. So when we do M&A transactions, we like to use partnerships to avoid this control requirement. Why? Because to meet the requirement, the transferors of property have to own at least 80% by vote and value. And when we say value, it's with respect to each separate class of non-voting stock. That's under Revenue Ruling 59-259. So those are your three elements: transfer of property solely in exchange for stock, and 368 control immediately thereafter. And so you get into these questions of, well, what does it mean immediately thereafter? What does the code mean by that? We have a whole set of legal doctrines that hopefully you all have heard of, called, you got the step transaction doctrine. There's a business purpose doctrine out there. There's some other doctrines. But the step transaction doctrine always comes into play here when you have a series of transactions that amount to what you're trying to qualify as a 351. There are 4 tests. I'm not going to get into all of them. I'm just going to summarize them here. The binding commitment test: was there contractual legal obligation to effectuate both parts of the transaction? So like, let's say I say, in a contract, I'm going to later issue more shares to Owen, who's contributing services. If he owns more than 20% of the company, and that's part of a binding obligation in the initial deal, that could bust your 351 and require you to recognize gain. The end result intent test just looks at the intent of the parties and whether they intended the end result to be one where a non-transfer of property holds more than 20% of the value, vote in value or value after. Mutual interdependence is your old but-for test that you learned in law school. But for the second transaction, would you have effectuated the first part of the transaction? And then there's this alternative transaction test that some courts will look to, which is, was there another way of doing this other than inserting this intermediate step to get to the end result that you're trying to achieve? And just, keep that in mind. So what happens if you get something, if the corporation sends you back something other than stock? So let's say, for example, 4 people contribute property, and one of them, as part of the contribution, puts some cash in, and one of the other shareholders takes the cash out. Well, what is that really? That's really a divestment from the underlying assets. And so to the extent that that occurs, the code in 351B says, you know what, we'll let you have non-recognition except to the extent that you've divested. And so what you need to think about is that in a 351 transaction, there are multiple pieces of property perhaps being transferred into the corporation. And to the extent that you're cashing out on some of those assets, you're taking cash back out or extracting value, you're going to recognize gain. And that's done on an asset by asset basis. This revenue ruling here, 6855, is super important. So I want you, I have it in here. You can go back and reference it. But what it does is it says each asset is being exchanged in exchange for a proportionate amount of value based on the relative fair market value of what you're exchanging. And we're going to calculate realized gain on each asset and then allocate the boot that you receive to each of those assets. And you're going to recognize gain on each of those assets to the extent that you realize gain, but only limited to the amount of non-stock or boot that you receive back, cash boot or some other property that the corporation gave back to you. The character, this gets important, when you have depreciable property versus capital assets, 1231, 1245 recapture can come into play, things like that. So the type of gain, whether if you're an individual, if it's long-term capital gain property, you're at 23.8%. If it's an ordinary income recapture, you're going to be, at 37% in the highest tax bracket. And then just be aware that there's section 1239, where there's a sale between a corporation and a more than 50% shareholder of depreciable property. There's some ordinary income recapture that could come into play with section 1239 as well. How do we treat liabilities? So a lot of times, these 351s there to facilitate utilization of the corporate form and to minimize the tax impact where you really do retain control or investment in the underlying assets. What 357 does is it says is Congress came in and said, you know what, a lot of these corporate ventures are debt financed or there's a component of liabilities that come into play, and we don't want to punish taxpayers for financing business operations and then incorporating those business operations into a C corporation unless there's a real abuse going on. And that's what 357 does, is it says we're not going to treat the corporation's assumption of liability. So I'll give you an example. I own a building. Owen and I are starting a law firm and we're going to form a corporation. Okay. And I own a building that we're going to practice out of. The building is subject to a mortgage loan. If I contribute the building that's, say, worth $200,000 subject to a $100,000 loan, and Owen contributes $200,000 cash to fund our working capital to begin our operations as a law firm, the fact that the building had $100,000 of debt is not going to force me to recognize gain. Okay, it's not going to be treated as though I received, because I've been relieved of that debt by virtue of the corporation assuming it or taking subject to it. I am being relieved economically, but it's not treated as though I received cash back. Okay, contrast that with the partnership rules, which does treat it as a cash distribution. Now, that's true with two exceptions. One is for a tax avoidance or non-bona-fide business purpose, which is usually easy to get around, hopefully. But if there's a tax avoidance purpose, all of it is treated as cash food. The other big one that I want everyone to be aware of is Section 357C. And that is where you have aggregate liabilities that go into the corporation that exceed the aggregate basis of the property that the transferor shareholder is transferring to the corporation. Then the transferor picks up gain to the extent of the excess aggregate liabilities over aggregate basis of the property transferred. For those of you who went to the University of Florida and took Professor Dennis Calpe's class, you'll remember that as being Tufts gain. That's the concept of Tufts gain. So if you're interested in the reasoning behind all of that, you can read the case Tufts versus Commissioner. So that's 357. When you're planning these transactions, it is pretty easy to get out of 357C if you're willing to rely on these two cases, Parachi and Lessinger, which say that a solvent obligor can make a note to the corporation instead and avoid Section 357C. So let's say in my example, my basis in my building was only $50,000 and the mortgage loan was $100,000. I would have otherwise had $50,000 of 357C gain when I contributed that building to the corporation. I can contribute a note for $50,000 to the corporation or make a note to the corporation and under Lessinger and Parachi avoid recognizing 357C gain so long as I'm a solvent obligor on that note. Okay. I have a note here also about, when we're talking about debt, if you contribute a receivable due from the corporation, there's an exclusionary provision in 108E. I thought that this was a related concept here. So there's a COD income, cancellation of indebtedness income element that you have to consider, but Section 108E6 allows for a gain exclusion in that instance. Basis, real quickly. So the corollary to non-recognition in any of these provisions that we're going to discuss, and also in partnership tax and some of the other ones, is that we use tax basis to track the gains that have been recognized or not recognized. In other words, to preserve the taxability of built-up appreciation in an asset. That's what basis does, generally speaking, within the code. So how do we preserve the basis? Well, the shareholder is going to take an exchanged basis in the stock, meaning if I had a $50,000 basis in the building that I contributed, even though I put $100,000 of value into the corporation, my basis is going to be $50,000. So if the corporation were to liquidate that asset and have $50,000 of gain, well, we'll talk about the corporation's basis in a second, but if I were to sell my stock, I too would have to recognize gain for that built-in appreciation that was inherent in the asset that I contributed at the time of contribution, but then deferred the gain recognition. And that's the whole idea of deferral and then basis trapping the gains that have been deferred. Like I said, similarly, the corporation, this is under Section 362, the corporation is also going to take what's called the transferred basis. By the way, for those who were ever interested, Section 7701 in the code, I believe it's 42 and 43, define exchanged basis and transferred basis. And sometimes you hear the word carryover basis. Carryover basis means both of those things. It's where your basis is determined in whole or in part by the basis of the property that you're giving up, right? So a 351 transaction, a 721 transaction, 1031 transactions, and 361, which we'll talk about in a moment. There is one exception here where you have an aggregate built-in loss, in which case you have to bring the basis of the assets to the corporation down to the fair market value. So you can do it on an asset by asset if they're individually little losses, but overall, no overall built-in loss. When you do the 351 transaction, there's no consequence. But if you have an aggregate built-in loss of the assets that you're contributing, then the corporation actually has to reduce its basis down to the fair market value. So you what ends up happening is the loss vanishes. You lose the tax attribute of that loss. There's an election to instead have the contributing shareholder reduce his basis or her basis in the shares. All right, real quickly, summary of tax consequences to the party. So if you qualify for for 351, there's non-recognition of gain or loss to each of the shareholder in the corporation. Okay, you get the carryover basis, like we said, that preserves the deferred gain. And note the aggregate built-in loss rule there for the corporation. And then everybody gets a tax holding period, except for the shareholder, it depends on what assets you contribute. So if you contribute capital or 1231 assets, you get a tax holding period, meaning you get to add the holding period that you had in the asset to your holding period of the stock. So if you sell the stock a day after you incorporate, but you held all of those assets, which were capital assets, for more than a year prior to the date of incorporation, you still get long-term capital gain. That's the benefit of it. Again, shareholders, you have to have a 1231 asset or a 1221 capital asset to qualify. Corporations get a tax holding period regardless. The effect of this rule is really the same. If it's an ordinary income asset, it's going to produce ordinary income to the corporation anyway. So the holding period is not going to matter. All right. Was that fun? I'm going fast. So am I doing distributions here, Owen, or did you want to?
Yeah, we got you down for distribution.
Okay, I'm going to do distributions too. So now we've formed the corporation, it starts operating, and it starts making money. Yes. How do we get that money out of the corporation? Well, we do it by having the corporation make a distribution. And so we're going to go through 3 different types of distributions. The key distribution provisions are 301, which are your 3-tier structure that we're going to talk about here. That's your default. 302, if you can qualify, is a distribution and redemption of your stock. That could give you sale or exchange treatment, which means capital gain. If you qualify, we'll talk about how to qualify. And then we're going to move on to redemptions that Owen's going to talk about, and that's in 331 and 336, or 332 and 337 if it's a if it's a liquidation of a subsidiary corporation into its more than 80% controlling C corporation parent. Okay, so here we go. 301. It's a 3-tier system. I like to describe it as a vat. And you can put think of these layers in a vat that are going to come out. And the idea is, under our system, the first dollars that come out are a return on your investment, meaning out of the earnings of the corporation. Owen and I formed this corporation. We each put in $200,000 of value, or $100,000 of value each, let's say, to form our law firm. And the law firm makes $100 the first year. That first $100 of earnings, if we distribute $50 to each of us, because it's out of the earnings of the corporation, above and beyond what we invested, that's going to be taxed to us as a dividend. Okay, the rate on dividends now is the same rate that applies to long-term capital gains if it's a qualified dividend, which most domestic C corporations do produce qualified dividend income. But it didn't always used to be that way. It is technically ordinary income. The second layer that comes out is a return of our investment. So Owen and I invested the $100 each. the company made $100 and we decide to pay out $150 because one of us, we converted some stuff to cash and we had a little bit of extra cash. So now we're coming not only out of the $100 that we earned, but an extra $50. What does that represent? Well, it's a return of our initial investment in the corporation. Okay, that's 301(c)(2. That is non-taxable. A return of your investment in something is not taxable under US tax principles. And then 3, a true divestment or taking of gains. Let's say we made the $150 and we each only had let's say a $25 basis. So the $50 that was allocated to each of us of a return on investment. Now we have money that comes in above and beyond our initial investment and above and beyond all the earnings that we made. That's going to be treated as a gain from the sale or exchange of stock. How does that happen? Let's say the corporation goes out and borrows money and makes a distribution of borrowed money. We're using borrowed money to return money to ourselves above and beyond what we invested and what the corporation actually made. That's how you get there. That's treated as a gain from the sale or exchange of the stock, which could be long-term or short-term capital, depending on how you hold the stock, how long you've held the stock. And remember that tax holding period, so that's important. Redemption distributions are treated differently. Here are the definitions. So you have a dividend is anything out of the earnings and profits. We'll talk about that. And then everything else, return on investment, and then a return above and beyond investment, which is sale or exchange. Earnings and profits is a whole nother course. I see that we're getting towards the top of the hour here. So let's keep moving. We can talk more about earnings and profits at another time, but I want to get through the rest of this. So I gave you sort of a distribution analysis. I've already kind of walked you through it. Note also that when a corporation distributes appreciated property, the corporation recognizes gain but not loss. That's under section 311. That's one of the features that makes corporations less beneficial than partnerships. Partnerships don't have that feature. S corporations and C corporations do. All right, redemptions. I'm going to turn it over to Owen for redemptions.
Okay, so redemptions are when somebody has a significant portion of their stock get bought by the company. It's really, the focus here is really on the divestment of somebody's investment in the company. And the big difference here is if you can get the money coming out qualified as a redemption, it's treated as a sale or exchange instead of a dividend. So if you fail here under the redemption, you wind up under 301, and then you have to go through the process of treating it like a dividend. So basically, on the next slide, there's a bunch of tests under section 302B, and they are the not essentially equivalent to a dividend test, which is a facts and circumstances test, which we're going to talk about these in a little more detail in just a second. Substantially disproportionate with respect to the shareholder. That's a safe harbor test. You have to have voting stock that's involved in that. The termination of a shareholder's interest is a complete termination. That's helpful because that is the only one of these tests where you don't look at attribution under section 318.
You have to waive. There's a waiver of attribution, right?
Yeah, there's a waiver of attribution. And then the number 4 there, the redemption of the non-corporate shareholder and a partial liquidation of the distributing corporation. Number 4, you have to look at what's going on inside the corporation itself to know whether or not you've got a partial liquidation for 4. And then 5 is something that we're not going to really go into at all here, which is the redemptions by certain regulated investment companies.
So just to summarize, as we get into these. So if you want to think about redemptions, basically you have these tests, and if you don't meet one of these tests, you're back into everything we talked about before, 301. So you're trying to get capital gain treatment, sale or exchange treatment, where you get to offset. One thing that's different between a dividend and sale or exchange treatment is you get to utilize your basis to offset your gain, whereas a dividend is taxed in gross, meaning based on the full amount, there's no basis consideration. So let's get into these.
Yeah, and you can meet any one of these tests. You don't have to meet them all.
Yeah.
Any one of them. any one of
And
them.
I put them in a different order than the numbering order in the code, because these are the ones that are the easiest to qualify for down to the hardest to qualify for.
Yeah. And then the 2 points on the prior slide, you had 2 points down there that I think are actually really important to point out, and that is, we talked about this just very briefly, but those attribution rules under Section 318, they do apply. They do apply. So when we talk about, a father in a corporation has his shares redeemed and where his voting rights were substantially taken away, there's other family members that still own stock. You can wind up with a situation where you don't have a redemption.
Right.
And then the last thing on this is like the step transaction principles. That's something that Adam talked about earlier. But anytime you're dealing with a corporate transaction, you should be thinking about these anti-abuse judicial doctrines that pervade the code in here.
And they're codified in 302 for certain types of redemptions.
Yeah.
So, yeah.
Okay, so complete termination is exactly what it sounds. Basically, you're completely taken out as a shareholder. It's one of the only types of ways you can qualify that doesn't involve any voting stock at all. And the attribution rules can be waived in this situation. And then down there at the series of distributions. Correct me if I'm wrong, Adam, but I believe that you can do a series of distributions for like pretty much any type of redemption, provided it's with respect to a plan. Is that
Yeah. Generally, yeah. So it's statutorily in there, but a lot of those step transaction doctrine principles are going to apply in any corporate transaction. So just keep them in mind. And I put together a PowerPoint presentation for my clients, a slide deck that shows what the plan is, and we have evidence of it. So if we're trying to qualify with a series of steps, if the government ever asks, we have a step plan that's signed off on by the client before we execute any of these transactions. So it doesn't have to be a PowerPoint deck. It can be, a document, a legal document.
Okay.
Okay.
All right. Substantially disproportionate distributions. One thing to keep in mind here is that you have to have at least some voting stock to qualify under this. And then there are two tests. The shareholder has to end up with less than 50% of the total combined voting power of all the classes of stock immediately after the redemption. And he or she has to lose at least 80% of his voting power in the process. So that's important to keep that in mind. That's just kind of a safe harbor mechanical rule. And again, just remember that you got to deal with 318.
Yep. No waiver here. You can't waive family attribution here.
No waiver there.
And then this one, and Owen will talk about it, but this is the one that you don't want to have to rely on because it's facts and circumstances. But go ahead, Owen.
Yeah, so this is, if you don't qualify for anything else, you can always argue that it was not essentially equivalent to a dividend, or at least try to. The test is whether there's been a meaningful reduction in the shareholder's proportionate interest, and that just opens up a whole can of worms. But basically, if you're looking at a meaningful reduction, the focus that they're going to look at is whether or not you had a reduction in the amount of control that you have. That's really the test. And so, like if there's this revenue ruling that's down there, 77-218. If after the redemption you still control more than 50%, then you're including indirectly through 318. You probably didn't have a meaningful reduction in your interest.
Yeah. How do you really get there? Because I get this question also on 1202. I get this question because a redemption is treated as a sale of the stock, which gets you into the gain exclusion rule, right? So if you can qualify, the biggest issue here is and they look at effective control, a lot of these rulings. So like, think of situations where you have voting rights, but it requires a super majority. If you can get, maybe you have an argument where if you get your shareholder down below a super majority, then it's not essentially equivalent to a dividend because you can no longer single-handedly effectuate corporate transactions. There are some other revenue rulings listed here where, you know, the ability to vote together with other shareholders as a group to effectuate a corporate transaction. If you lose that ability, so like one shareholder goes out and you go down a little bit, and now you can't do that. So those are your sort of like facts and circumstances that I just happen to have read a lot of these revenue rulings recently. That's why I'm just, you know, throwing my 2 cents in here.
Yeah. And then this is one of the situations where, you know, maybe you can get a redemption even if you're just using non-voting stock or preferred.
Right.
And it's maybe a little hard to qualify, but there's a possibility that you could.
Yeah. And then this last one here, I think, partial liquidations. So,
Yeah.
you know, what we're looking at here is sort of like the corporation divesting from, you know, maybe they have 2 lines of business and they get out of 1 line of business, a real corporate reduction or contraction in their business.
Yep. And that's really all there is to say there, right? You have there's
limited to non-corporate shareholders. That's another important point of this one. You can't have a corporate shareholder. Okay. We'll pass on this. This one gets really complicated. I'll just throw it out there because we're running low on time. Be aware of Section 304, redemptions through related corporations. The most common one is this brother-sister relationship where you have parent owns brother and sister corporation, parent or shareholder sells brother corporation to sister corporation. That's going to be tested as a redemption. In that scenario, it's going to be treated as a dividend. So you go through the 302 analysis, you end up in 301, and it becomes a dividend. In the international world, we use this transaction all the time to move tax attributes around intentionally. So that's just something to be aware of. The other one is a parent subsidiary relationship in the purchase of Cook stock. All right, liquidations.
Okay, so there are basically 2 types of liquidations. One of them is the liquidation of a controlled subsidiary. If you have the liquidation of a controlled subsidiary, everything flows up into the parent, including tax attributes. It's pretty simple. If you have a liquidation that's not a liquidation of a controlled subsidiary, then it's treated as a sale or exchange, and that's essentially what the rule is. We're short on time. You got anything else you want to add, Dan?
All right. Yeah. So in a parent sub-liquidation, that's akin to these other non-recognition provisions. It's a 381 transaction, meaning the tax attributes flow up to the parent. Let's see. Anything else important? Oh, granite trust planning. This is a good sort of like tax tip here is you can sell a portion to get out of your 80% control to avoid the non-recognition provision if you want to recognize a loss. That's called granite trust planning. So if you have a built-in loss on the stock of the subsidiary and you want to recognize that loss, you can use 331 and 336 in this granite trust case to actually get below 80% and then liquidate. So you maybe sell the stock to a third party and then liquidate. So we have like 5 minutes left here. We'll do quickly taxable acquisitions and reorganizations, and then wrap up. So
5 minutes.
I can do this in 5 minutes. All right. Key considerations in taxable acquisitions. Do you want to do a stock deal or an asset deal, or for corporate purposes, a stock deal and make a 338 election, which treats it as an asset deal? So basically you're balancing competing interests here, and it's going to depend a lot on the bargaining power of the parties. Most buyers try to effectuate an asset deal. Why? Because they get a basis step up for the assets, for the amount that they pay. They take a section 1012 cost basis in the assets, and they get to redepreciate the assets at the new cost or amortize the goodwill over 15 years as an amortizable and 197 amortizable intangible, right? The seller, on the other hand, wants capital gain treatment. They don't want to recognize ordinary income and depreciation recapture on all the assets that they're selling. So they prefer to maximize the amount that is capital gain. And to achieve all capital gain, if they sell just the stock, 100% of its capital gain. So those are key considerations. On an asset sale, the corporation is going to recognize the gain or loss on each asset, and then you have the liquidating distributions that will come up to the shareholder, double taxation there. This is a big one in taxable acquisitions, is the Section 1060 purchase price allocation. And in transactional tax, we deal with this a lot. The buyers and sellers can agree to it. So this is what amount of the purchase price is allocated to each asset when you do an asset deal or a transaction where you do a 338 election to treat it at a stock deal, what was otherwise a stock deal, as an asset deal. And so this is negotiated between the parties. Usually they agree to the allocation, and then and it's usually done by contract. And then there's a form that's filed by each of the parties with the IRS so that the IRS knows. What's important here is that that agreement is binding on both parties and presumptively correct for the IRS, unless it's manifestly unreasonable. So here's Section 1060, how you deal with inconsistent allocations. What you need to know about 1060, it's what's called the residual method. So you have the actual assets, and I list them all out here for you, class 1 through 7. And basically you start with your most liquid assets and you allocate based on fair market value. And then everything that's left over at the end gets allocated to goodwill, which is an amortizable 197 intangible. One thing to note here that just came up on another deal, that the Tax Cuts and Jobs Act, effective 1/1/2018, changed the rules so that certain intangibles are no longer treated as long-term capital gain type assets, and they can instead produce ordinary income. And those are, if it's self-created or acquired from the taxpayer in a non-recognition transaction by the person who created that asset. That applies to patents, inventions, models and designs, and secret formulas. The buyer is typically indifferent. So what you want to do here is make sure that on your 1060 allocation, you are allocating it to intangibles that do yield long-term capital gain for your client. For example, customer-based intangibles or supplier-based intangibles. So usually, again, the buyer's indifferent. That should be an easy negotiation point. Finally, reorganizations in 2 minutes. I don't know. I teach a whole class on reorganizations that takes a semester. So let's try to do it. 368 is a definitional term for reorganizations. The policy is the same. Policy for non-recognition is there's just a change in the overall, the way that you hold those assets in those operations. Generally, tax consequences. Oh, good. This slide helps us get through it. 361 we talked about, and 1032, whenever a corporation issues its own stock, no gain or loss recognized. Carryover basis, which is the corollary to non-recognition, tax holding period. And then the key here is 381, carryover of tax attributes. That includes net operating losses, but you have to be aware of 382 and the Survey rules, which could prevent the acquiring company from utilizing those losses. Here are the different reorgs. We have 1 minute left. I'm going to go through them in 1 minute. Ready? All right. Type A, statutory mergers. You have to have a law, statutory law that says that it merges by operation of law. Type B reorganization is a stock for stock exchange. One, you give up stock, you get back stock in the acquiring. A C reorganization is an asset reorganization. It's a purchase of substantially all the assets, and that's usually, you'll see that both C's and D's are asset reorganizations, both involving substantially all the assets. The difference is that a D reorganization is usually an internal restructuring because of the way that the control requirements work out. An E reorganization is a recapitalization that can be debt or stock for different types of stocks. So you go voting for non-voting, preferred for common, so on and so forth. F reorganizations we utilize a lot in the M&A context with S corporations. That's a mere continuation of form or identity. What you need to know about F reorganizations when you get to S corporations is there's a revenue ruling out there that allows you to keep the EIN of the old operating company. So if you need to keep the EIN, like in medical deals or government contract deals, we use the F reorganizations to set up our acquisition structure. And then G reorganizations, I don't do bankruptcy. I've never done a G reorg, but that's what it is. Here are the benefits and detriments of each. type of transaction, different types of consideration. I'll point this one out with our last minute here, is that some allow more boot or no boot than others. So a D, you can do what's called an all cash D, which is 100% boot transaction. Whereas a lot of these, like a type A, you can have 60% non-stock received. B has to be purely stock for stock, and it has to be voting. And C, 20% boots allowed. So you'll see the differences here. And then type E are recaps, and F, they're not really applicable. All right.
We're just over time here, but Adam and Owen, thank you so much. This has been a very informative presentation and a challenge to cover in 1 hour, certainly. A lot of information here, but a lot of gold nuggets in the presentation, the PowerPoint slides themselves. So thank you for sharing that with us. Does anybody have any questions? I didn't see any come through in the Q&A box. I'm not sure if the presenters saw any come through on their end.
I don't have any here, but you know, if you have any questions, I know last time I got some emails after the fact. You know, feel free to reach out. Hopefully, I know we started speeding up towards the end because I did want to get through the entire presentation and at least touch on, you know, each of these points. Like I said, this is just a framework for you to understand how the different provisions in Subchapter C work and where the issue spotters are, and throw in a few practice pointers. But I think if your practices are like mine, we spent more time on choice of entity for a reason. That's like the #1 question we get asked when we get on the phone with a client is, I'm starting a business, or, you know, I'm going to go into business with this guy. What's the best way to do it? What choice of entity, and how should we capitalize it? So we intentionally spent more time on those topics because we think that those are the bigger questions that get asked as tax advisors.
Right. All right. So I want to just share the CLE code one more time. It's 8207, 8207. Want to also thank our sponsor one more time, Jones Lowry, Marshall Jones on the line. Thank you so much for joining us today and for your contributions to the tax section of the Florida Bar. Adam and Owen, thank you both. The presentation was phenomenal. Marshall, we see you now. Just want to say thank you. Thank you. Great presentation, and appreciate you all. Thank you.
Thanks.
Thank you.